I'm Catherine Ross, and I'm here live from the NYC with Jim Cramer. Jim, let's kick it off by going unfiltered. What's on the top of your mind?
The incredible Teflon-like nature of Boeing and Caterpillar. Here you have Boeing, a company which is basically saying, listen, we have problems, but those problems will be resolved by year end. Now, I don't know how they say that. I wouldn't be so bold, but they basically think it behind them. Now, many of the suppliers I speak to do not think that's going to happen. They think that that's too optimistic. But if you believe Boeing, then of course you would buy the stock, and it's certainly, even though it's negative cash flow, if they have to shut the run, then you'd be selling Boeing. Now, Caterpillar. I mean, every single line, Caterpillar, we own this for action alerts. Now, I always play with an open hand. When an action alert company reports a number that's bad, I don't ever present it as good. This is a bad number. And yes, they were not episodic in their buyback. They were buying back stock the whole time. Texas Instruments, by the way, had the intelligence to not buy this quarter. Thank you, Eric Johnson, for saying that. But, look, when I see a stock that's having an estimate cut like that, I have to try to put a multiple on it. And I struggle whether I should just put a 10 multiple on it, which means that stock has considerable downside. We told people, listen, we think it's going to be an awful quarter because of the way that my restrictions are. Of course, I wasn't allowed to sell it for the trust, but it was an awful quarter. And maybe you think that there's going to be a trade deal and the Chinese are going to go buy a lot of, tractors, so to speak, or engines. But I recognize that Boeing should be down and CAT should be down, but the market wants to own these stocks. I don't trust them.
Now, Caterpillar is our real money stock of the day, but before we get to Caterpillar, I do want to talk about your real money column from this morning, which focused on Texas Instruments,
Yes.
As you said. And we saw the semis in the market in general take a dive last night after Texas Instruments forecasted weekly.
Yeah, that's exactly right. And Texas Instruments, frankly, has had a history of being, I was talking with Jeff Marks about this, he was looking at the April quarter where they said, listen, things are bad. They have a history of being downbeat. Second, Texas Instruments became the go-to stock. Why was it up more than 30% for the year? Thank you, Eric Johnson. Was because it was the one to hide in. It didn't have Apple exposure. It wasn't too much cell phone. It wasn't too much of what we regard as being the service provider stocks, which means service providers, as we all know, whether it be Cisco, whether it be Qualcomm. Everybody knows that that's been the weak area. So where you wanted to do, you wanted to hang out in NXP and analog devices, and most importantly, Texas Instruments, because they really diversified into manufacturing. Whenever you heard digitization, you always said, woo, that's got to be Texan. Whenever you heard automobiles filled with chips, that was Texas Instruments. So now you reap what you sow. So I feel like the Texas Instruments very much is no longer representative of the index. It's representative of analog and on semi. It's certainly representative of microchip and representative of NXP, but not of Micron. And I say the better way to look at it is Taiwan Semi, which had a bigger company, by the way, in Texas Instruments, really had good things to say about a lot of semi-world. And then Teradyne last night, a very good company. I've known the management there for 20 years. Teradyne said very good things about the DRAM segment and about the cell phone segment. So let's be careful in reading too much into Texas Instruments. Not that they didn't execute well, they do. Not that they aren't a cash cow, they are. But their markets are the markets that we're seeing weakness in across the board. Ford, GM. I mean, honestly, I think they're more levered to autos now than they are to cell phones.
So you don't think that Texas Instruments could be a bellwether for the semis?
I think it's a bellwether the semis, like many areas of this market, are no longer the same. I mean, we unfortunately we have these ETFs. And all they have to do is look at semi, and the second algorithm says semi. Therefore, they could do semi truck. I mean, they could do chip, and they have Frito-Lay in these indices. The indices are so stupid, but people are so greedy to put together these ETFs. Greed that what happens is they tend to move stocks all together. And I would say, for instance, here's a classic one. Nvidia was down 4 last night off of Texas Instruments. Texas Instruments has as much to do with Nvidia, as I would say General Mills has. I mean, honest to God, Nvidia is artificial intelligence. Nvidia is self-driving. Nvidia is Grand Theft Auto, so to speak. Nvidia is a visionary chip company. Jensen Huang named the number one CEO in the world by Harvard Business Review yesterday. Second is Benioff. And I look at them and, is there some overlap? NVIDIA has just produced these really unbelievable 5G products, and so there is some overlap. AMD has some overlap. But when I look at the firmament, the idea that these are all the same kind of company has to do with the SMH. ETFs are wrecking this market. I don't mind the S&P. I don't mind the GLD. But ETFs, the great untold story, because so many people are on the take, the great untold story of this period is that the ETFs are fraudulent in many cases. And they have made you feel that Nvidia is the same as Texas Instruments, which is the same as AMD, which is the same as Microchip. And the companies themselves would beg to differ, and I side with the companies.
Let's talk about another bellwether, and that's Caterpillar, which, as I said, is real money stock of the day.
Right.
Now, Jim, those earnings, is that...
Up.
I know. Were those earnings because of the U.S.-China trade war? Is that having an impact?
A lot of it is. And a lot of it is, there's a slowing in the world. If you take a look at Norfolk Southern cargo lines, first quarter versus this quarter, you'll see there's just a slowing in every cargo line that's industrial. And Caterpillar's levered to industrial. It's not like Caterpillar's suddenly the medical instruments business. You can change your stripes if you're Texas Instruments and shift from, small scale device to auto. But Caterpillar is not suddenly going to become a company that's in the life sciences, all right? Caterpillar has end markets, and those end markets are all getting weaker. By the way, oil, look at the drilling numbers, look at the rig numbers, look at the pipeline build. I mean, everything that Caterpillar's in is under pressure. So Caterpillar cannot transcend its end markets, and that's kind of the theory of this moment. Who can transcend their end markets? And I'll give you an example. Honeywell and United Technologies have transcended their end markets because even though they are industrials, they're embedded in certain parts of the aerospace cycle. Now, if Boeing were to have to shut down production of the 737 MAX, then you would see tremendous number cuts in United Technologies. But right now, those are industrials that have gotten in what I regard as being secular growth mode end markets. Caterpillar is not in secular growth mode end markets. What's interesting is some people, including my writing partner, Matt Horween, are saying that perhaps the Deere is in a much better secular growth mode because the farmers of the world, no matter what, always seem to be given money. If you're a Brazilian farmer, you get the big soybeans order from China. If the U.S. loses the Chinese order, then suddenly that the farmers get money from the president. NAFTA, so they get the new agreement with Canada. Well, that's really fabulous for the U.S. farmers. So it seems like that there's this bifurcation. Is the end market in secular growth mode, Deere, or is the end market in cyclical decline mode, Texas Instruments?
All right, Jim, I'm going to give you a lightning round here. Oh, yeah. Here we go. Now you got to write another real money column.
Sure.
Head on back.
Done.
All right, so we're going to do a lightning round. We had three.
Lightning round.
Yeah, we had three companies that announced CEOs last night. We had Under Armour, we had Nike, and we had ServiceNow. So you got to give me 3 reasons in 60 seconds why I should care as a millennial.
All right, are you ready, Ski Daddy? I think that Under Armour very much needed not a founder, but someone with organizational skills like Mark Parker after Phil Knight left. So, boom, I like that. Mark Parker, way too young to retire. I wish it weren't going to happen. Incredible 10-year TSR, but maybe we need to change because you know what? Donahoe has a much better TSR over a 5-year period. Bill McDermott, welcome back to the fray. I do think that now pre-announced better than expected numbers. They're going to be, I have John Donahoe on tonight on Mad Money. So he's in good shape.
All right, Jim, thanks for joining and thanks for doing the lightning round.
Of course.
All right, guys, if you're watching on TheStreet.com or on Facebook, we are now heading over to our Action Alerts Plus daily show over on ActionAlertsPlus.com. Catch us there. I'm Catherine Ross, and we'll see you tomorrow.